Okay, so here's our quick review, and then we will continue on. We are learning this week about financial statements, including the statement of cash flows, income statement, statement of owner's equity, which is sometimes called the statement of stockholders' equity if you're dealing with a corporation, and the balance sheet. We learned the difference between current and non-current information and how that applies to assets and to liabilities. And we looked at some other types of accounts as well. So let's see quickly what we've already talked about. We know that sole proprietorships have one owner, and that owner pays taxes on the profits of the business on their own income taxes, right? But if you have a partnership, that means there are multiple owners, and the profits are divided among the owners, and each owner pays taxes on their share of the profits, right? With a corporation, you can have as many investors, and the investors are really owners, as you want. Especially if it's a publicly traded corporation, you could have thousands of investors. One downside with corporations is the corporation has to pay tax on its profits, and then the investors pay taxes on any dividends that they get from the company. So that's double taxation. Okay, let's see. All businesses use financial statements, regardless of the type of business. These financial statements benefit multiple different stakeholder groups. Talked about how making financial statements is kind of like making a cake. You probably remember that analogy. We saw a very simple income statement. The basic formula again is revenue minus expenses equals your net income or what? Net loss. Correct. We did exercise 9, right? Okay. So we know that a net loss occurs when the expenses are greater than the revenues. We did problem number 1. Well, we did part of problem number 1, right? We did March, and you will be doing January and February and commenting on each month if you haven't already done that. We talked about how Starbucks has multiple sources of revenue, multiple things that it can sell to make money. It also has multiple types of expenses that it has to pay in order to operate its business. We then learned that really the formula for the income statement is a little more complex because sometimes you have gains and sometimes you have losses, and you have to factor those into the calculation. What causes gains or losses?
Selling assets.
Exactly. The sale of any assets that are not your product or service leads to either a gain if you made money in selling that asset, or a loss if you lost money in selling that asset. And later on, we'll learn how you determine a gain or a loss, but don't worry about that just yet. So here's really the real formula. If your revenues and your gains are greater than your expenses and your losses, then you have net income, you have profit, right? On the other hand, if your expenses and your losses are greater than your revenue and your gains, then you have a net loss, right? I think I said that right. Then we did exercise 1 together. Oh yeah, that was fun, right? Solving for X. Hopefully you got the idea about that. And that was it. That was as far as we got, right? Any questions on any of that material? As I mentioned, I know it's a lot to take in these first couple of weeks, a lot of new concepts and words. Hang in there. And even some formulas. But hang in there. Once we get through these first couple of weeks, you'll have the basics down and it'll start to make more sense. All right. And so this is where we will pick it up then. The statement of owner's equity. Now, I've mentioned that we call it a statement of stockholders' equity if it's a corporation, because corporations can sell stock, right? So it's the stockholders that own the corporation. So if it says statement of owner's equity, what type of business do you think this would be? Not a corporation. Sole proprietorship, you said that. Yeah, good job. Okay, so yes, this would be for a sole proprietorship, which generally are smaller businesses than corporations. And this is Chris's landscaping business. Name of his company. We see it's a statement of owner's equity. We see it's for the month of August 2020. And it's a very simple statement. It says that at the beginning of the month, Chris had 0 equity. Well, like a truck going by? What's that? Okay. Thought for a second, maybe it was an earthquake, but nothing was shaking, just rumbled. Okay, so Chris had 0 equity. That suggests to us Chris probably just started the business. And he didn't put any money into it yet. So the business doesn't own anything, doesn't have any assets, doesn't have any liabilities, and doesn't have any equity. But in that initial period, he had a net income of $250. Where do you think the net income came from? Sales, yeah. He probably got some customers, made some sales. He might have had some expenses, which would have then reduced the net income, but the ending net income for that period was $250. That's how much profit he made. Now we add that to the beginning owner's equity to find out the ending owner's equity. So at the end of the period, the value of his company is $250. Okay, that's the amount of equity. Do you have any questions? Okay, so you see a statement of stockholders' equity is pretty short and simple. Sometimes they're a little bit longer, but really they're usually not very complicated. Okay. All right, possible changes to owner's equity other than net income. Well, I think I ought to move that green bar out of the way so I can see it a little better. Anytime Chris or any owner puts more money in, that increases the equity of the company. In fact, he could even contribute equipment or a building. So let's say Chris had a truck that was his own personal truck that he decided to contribute it to the business, and then it would now be the company's truck. Well, he could do that and count it as equity for the business, and that would increase the equity, the value of the business. And he can also take money out. Let's say he, out of that $250 profit, he decided he wanted to pull some of that money out and use it for his own personal reasons. He could take that money out of the company as a distribution and put it in his own personal bank account. Now, you do want to have separate bank accounts for your business and your own personal finances, even if you have a sole proprietorship, because that just helps make it clear what's your money and what's the company's money. Especially if you get audited by the IRS and they want to know how profitable your company was and they want to look through all your records. They don't want it mixed up with your own personal finances. Okay? But you can, as an owner, put money in and take money out. Okay. Any tech genius out there that can help me figure out why PowerPoint keeps doing that, I would appreciate it. Let me know. Okay, let's move on to another financial statement, the balance sheet. We learned about the accounting equation already. Who remembers the accounting equation? What is that formula?
Assets, liability plus, equity. Assets equals liability.
Okay, assets equals liabilities plus equity, right? And that's what we see here. Here's Chris's landscaping's balance sheet. Now, the balance sheet is the one financial statement we'll be using this semester that does not cover a period of time. I might have mentioned that on Monday. It covers a point in time. So it's a snapshot of the company's assets, liabilities, and equity on that day. So we see on August 31st of 2020, the company had $250 of assets. It had no liabilities, and it had $250 of equity. Does that formula hold true? Yes. Chris's assets equal the liabilities plus the equity. Now, we already said this equity, that net income, remember, that increased the equity, probably came from sales. Where do you think the assets came from? In this case, if he had $250 of sales and he has $250 of assets, I'm assuming Chris is male, maybe Chris is female, but where do you think the cash came from?
Renting,
Rented?
like lending, renting.
Well,
Hello, rent.
if Chris made sales of $250 to his customers and they paid him, he would have $250 of cash, right? That's the most logical explanation. Because remember, with our double entry bookkeeping system, every transaction gets recorded in two places. So when you make a sale and you get paid, you record that under sales and you record it under cash. Because you made the sale and you got the cash. So it was one transaction, the two different accounts get updated. Okay, any questions about that? So balance sheets follow the same basic format. This one is very simple, but they generally tend to be fairly simple. Even if they have more detail, they follow the same formula. All right, here we see the relationship between these three financial statements. We see Chris's income statement, which showed he generated $250 in net income, right? This was his total sales minus his expenses, and what was left over was the profit or the net income. Now that net income gets added to the beginning equity, which happened to be zero, to show that the company now has a value of $250. And that ending owner's equity is what showed up here on the balance sheet, right? So we see the value of the company in the equity. We see the value of everything the company owns in the assets. And he has no debt, or the company has no debt. Okay. And so you can see the relationship. If you were going to make these three financial statements, which one would you make first? The income statement, exactly. Because you need that information before you can make the statement of owner's equity, and you need that before you can make the balance sheet. So you're already familiar with 3 of the 5 financial statements that we will be making this semester. There's still a lot to learn. So, any questions at this point? All right. Well, here's a 4th financial statement, the statement of cash flows. I think I mentioned this on Monday, but who can tell me, why do we need a statement of cash flows if we already have an income statement that tells us how much profit we made? Is profit the same as cash flow?
No.
No, so what's the difference? Profit is your sales minus your expenses, right? And I think I mentioned on Monday, you could have sales, but maybe your customers haven't paid you yet, so you didn't get the cash. And you could have cases where you have an expense that you haven't paid for yet. And that's why we need a separate statement of cash flows. Now, there are some companies that use cash accounting. And in cash accounting, your statement of cash flows would be the same as your income statement. Because in cash accounting, you only count the sale when you actually get the cash, and you only count an expense when you pay for it. But most companies are not allowed to use that method. You have to be a small business or a nonprofit to be able to use the cash basis of accounting. And you probably don't want to anyways, because the normal method of accounting gives you a better view of how profitable your company is. Okay? So pretty much all companies use the accrual basis of accounting. I know it sounds like I'm saying cruel, but it's accrual. And the accrual basis of accounting says that you count a sale when the sale occurs, not when you get paid. And you count an expense when the expense occurs, not when you pay for it. Okay? And so that's primarily what we will be seeing this whole semester is the accrual basis of accounting. Okay, you got that? All right. So this table really shows the difference between the two methods. There's a lot of information here. So just to emphasize, let's say a customer made a purchase and they paid for it at the same time. Well, then it really wouldn't matter whether you were using the cash basis or the accrual basis, because you would be recording both the payment and the sale at the same time, because that's when the customer paid. But it's when the customer makes the purchase and then pays in a different period of time, that's when it makes a difference. That's when it's going to look differently depending on whether you're using the cash basis or the accrual basis. Which approach did I say we're going to be using primarily in this course? Accrual. Okay. Okay, another exercise. So I'm going to pause the recording and we will do this. I also want to check my notes here. All right. I think did I talk about current versus non-current? Okay. I have an online financial accounting class on Monday night, so it's hard for me to remember what I talked about there and what I talked about here. Okay, so what does current mean in accounting?
Something like it could be paid off in a year.
Okay, so it means if we're talking about liabilities, that we can pay them off within a year. If we're talking about assets, it's money we plan to either use or an asset that we plan to use within a year. Or at least we could. Like, let's say we have cash in the bank, we could spend that anytime. So even if we're not going to, just the fact that we could spend the cash makes it a current asset. Okay, so if it's possible to use it within a year, it's a current asset. If you're planning to pay off your liability within a year, it's a current liability. Okay, and then if it's going to be longer than a year, we call that non-current or sometimes long-term, but they mean the same thing. So here are some examples. As I mentioned, cash would be a current asset. Accounts receivable, the money that our customers owe us, we would want to receive within a year, right? Otherwise, we're going to have our own cash flow issues. Now, here's a new term, notes receivable. A note in accounting is a loan. So if an account receivable means that somebody owes us money because they purchased something and they haven't paid us, what do you think a note receivable is? It's money we loaned that has not been paid back to us. So we can expect to receive that money at some point in the future. Okay. Now, notes receivable can be short-term if we're expecting to get that money within a year, or they could be long-term if we're expecting to get them after a year. Make sure you put your name on the list there. Inventory is also a current asset because you want to sell your inventory as soon as possible. You don't want it sitting around for a year. Let's look at some non-current assets. Buildings, land, and equipment are all expected to last longer than a year, right? Who would buy a building that was not going to last for a year? Unless you're planning to tear it down. Patents. If you have invented a product and you have registered for a patent to show that this is your invention, you're probably planning to sell that product for more than a year, right? So the patent is good for, I forgot how long, 15 or 20 years, something like that. And then I already talked about long-term notes receivable. All right. There are other examples, but hopefully you get the idea of current versus non-current assets. Any questions? Let's look at liabilities. Have we talked about accounts payable? Anybody know what an account payable is?
Amount borrowed.
Yes, it's when we owe money to somebody else. And this would be a case where we purchased something from a supplier, but we haven't paid them yet. So this is an account that we have to pay on, right? It's the opposite of an account receivable where somebody's going to pay us. In an account payable, we need to pay them at some point in the future. And you can imagine our suppliers don't want to wait a year to get paid, right? So those are current. So what do you think a note payable would be? I said a note is a loan, right?
Loan you gotta pay that.
Yeah. It's a loan we have to pay back, right? And if it's for less than a year, meaning we're planning to pay it within a year, it's a current note payable. If we expect that we're going to be paying it after this year, then it's a long-term or non-current note payable. If we're going to start making payments this year, but will not be done, and we're going to have to keep making payments after this year, then it's a long-term note, but part of it is current. So in that case, it kind of falls into both categories. All right. So we know current versus non-current, right? And we know it applies to assets and liabilities. All right. Why does it matter? So it matters because investors, if they're investing in a company, want to know not only the assets of the company, but they want to know how much of those assets are liquid. And that's another word in accounting that has its own meaning. What do you think liquid means in terms of accounting? Is that, yeah, it's easy to sell and turn into cash. Or maybe it's already cash, which would already be able to spend. So if you're an investor and you see that this company you're thinking of investing in has $10 million in assets, you might be curious, how much of that is short-term assets that they could quickly turn into cash? And how much of it is tied up in things like buildings and equipment that would be hard to turn into cash? Because then if the company runs into cash flow issues and they have to sell off a building, that's problematic, right? It's better if they have enough current assets available that they can pay for their short-term debts. Same thing with liabilities. It's helpful to know when you're investing in a company, how much of their debt they're planning to pay off within a year, and how much of it is long-term debt. And I'm going to relate this to your own personal finances. Let's say you were going to buy a home and you didn't have enough cash, because who does, right? Very few people can pay cash for a house, especially around here. So you'd have to take out a loan, right? That's called a mortgage. And a mortgage on a house, typically for 15 years or 30 years. I've even heard of 40-year mortgages. So you're gonna be paying back that loan over a long, long time. And let's say you needed to go to the store and buy groceries, but your paycheck hasn't come in yet and you're broke. Are you gonna take out a 30-year mortgage to pay your groceries? No, that wouldn't make any sense, right? So we use short-term debt for short-term assets, and we use long-term debt for long-term assets. The interest rates are different, the terms of the loans are different, and that helps illustrate why it's important for investors to understand how much of a company's assets and liabilities are short-term and how much are long-term. Okay. Does that make sense? Sort of? All right. Student loans. So those are sometimes a necessary evil, right? Unfortunately, higher education is not free for the most part. There are some cases where you can take college classes free, or even universities. Sometimes studying in other countries, they offer free university programs, even for foreigners. But for the most part, if you're going to be getting an advanced degree, you're gonna have to pay for part of the tuition, right? And one way to finance that, if you don't have enough cash available, would be to take out a student loan. So unfortunately, a lot of Americans, or American residents at least, find themselves in the situation where they do take out student loans in order to get their degree, in order to help advance their career and make more money later. And sometimes that works out and they can pay off their student loans, but sometimes they end up taking a long time to pay off student loans. Did you know that there's a difference between student loans and car loans in terms of bankruptcy? If you have a car loan and you get into such a bad financial situation that you can't pay for that car, you can go through bankruptcy court. It's a long, expensive process. I've heard it costs like $10,000 to go through the bankruptcy process, but don't quote me on that. It's not fun, but if you had so much debt that you could not ever imagine being able to pay it off, and you went through bankruptcy, you might be able to get through some of those debts reduced or maybe even completely dismissed, but not student loans. For some reason, even if you go through a bankruptcy proceeding, you still have to pay back your student loans. Unless, of course, the Biden administration has forgiven your student loans. You know, in recent years, many students have had their student loans forgiven. And that process is not over. They're still finding ways to forgive more and more student debt, okay? But it is not bankruptable, so that's one thing to keep in mind. Any questions on that? Yes, sir. Oh. Yeah, I don't think that debt passes on to your heirs. I think what would happen, and I'm not an expert here on estate law, but I think that whatever assets you have would be used to pay off whatever debts that you have. And if there are some debts left over, they just don't get paid. Your family, as far as I know, is not responsible for that. And if you have any assets left over, then according to your trust or your will, if you have one, that would help indicate who gets those assets. Now, sometimes that also has to go through court, through a probate court, and the judge weighs in on that decision. But that's all part of the estate planning process. Right. Any other questions? So we talked a little bit about these different types of business ownership. For sole proprietorships, when the owner invests money, we can call that capital. Okay, that's why capital and equity are very related concepts. Capital is the money invested in order to help grow a business, which increases the equity. And the owner can withdraw funds, as I mentioned earlier. Now, in a partnership, each partner can contribute capital and can also withdraw funds according to the partnership agreement. So they have to have an agreement in place about when they can withdraw funds and how much. Now, in a corporation, we have the same concepts, but different terminology. If you are an owner in a corporation, you're a stockholder. And there are two basic types of stock. There's common stock and preferred stock. We'll get into the difference in a future chapter. But that is your ownership. So the more you invest in the company, the more stock you have. When the board of directors elects to give you some of that money back, it's a dividend. So as a stockholder, you don't have control over when you get money back. It's up to the board of directors. You could always sell your stock to somebody else, but you can't force the corporation to just give you money. It's up to the board of directors to pay the dividends. And the profits that the corporation has not spent are called retained earnings. So that's another term that relates to equity. As the company earns a profit, the retained earnings of the corporation go up. And as investors buy more stock, again, the retained earnings go up. Okay? Is that right? Did I just say the right thing? Actually, technically, when the stockholders buy stock, the equity goes up, but it would be called contributed capital, not retained earnings. So that let me clarify, correct that. Okay. So as you see, it's the same concept, pretty much, just slightly different terminology for corporations. All right? Anything with clarification there? Let me just see where we're at to make sure we're on schedule here. Let's see. Okay, we're past the halfway mark, which is good, but we have a lot more to cover. So I'm going to try to pick it up a little bit. If I'm going too fast, let me know. We already know the accounting equation, right? Assets equals liabilities plus equity. We know that you could say that in different ways, right? We could say assets minus liabilities equals equity. Let's just look at this example. If we buy a $200,000 house and we take out a $175,000 mortgage, our equity in the home is $25,000, right? That's the portion of the home that we really own. I mean, legally we own the whole home, but if we sold it, we'd have to pay off the loan before the bank would release their lien and it would be completely ours, right? So we really only own $25,000 worth, the difference between the value of the asset and our debt. And it's the same for companies. But if we wanted to express this as assets minus liabilities equals equity, the math still works, right? 200,000 minus 175,000 equals 25,000. So there are certain ways you can rearrange formulas, and there will be times when we need to in order to solve certain exercises and problems. Right? Any questions on that? Who remembers which financial statement uses the accounting equation as its basis? The balance sheet. Because this side of the equal sign has to balance with the other side. They both have to equal. Otherwise, there's a mistake. Okay. This is an exercise that you could do. We're not going to actually do it here in class. If you take my managerial accounting course at some point, we do something similar where I do have you create your own personal balance sheet, where you indicate your assets, your liabilities, and in personal finance, we don't call it equity, we call it net worth. So when we're talking about our own money, your assets minus liabilities equals your net worth. But if you wanted to, you could go through and do this yourself to, hey, no worries, to get an idea of your net worth. Okay. This is one of those things, might take a little bit for it to sink in, but this is a really, really important concept. So if you've been napping, this would be a good time to focus and pay close attention. Otherwise, you'll be confused later, okay? We know that we have assets, liabilities, and equity. All right. In our accounting system, our double entry bookkeeping system, where everything gets recorded in two different accounts, we use debits and credits, which is just two columns. Like you see here, under current assets, we have a left column and we have a right column. And you see that also under non-current assets, see it under liabilities, and you see it under equity. Now, one of the hardest things about accounting is understanding and remembering when to debit and when to credit, okay? It makes sense, but it takes a while to get to the point where it makes sense. So you'll be confused for a little while. Eventually, you'll get it. So I'll give you the basic idea. With assets, when an asset increases, you record it in the debit column. When an asset goes down or decreases, you record it in the credit column. Debit's on the left, credit's on the right, okay? That's why you see the plus sign. So if an asset goes up, you record it on the left side, the debit side. And notice with liabilities, it's the opposite. When a liability goes up, you record it on the credit or right side. And then with equities, with equity transactions, it actually depends on whether that equity transaction is increasing equity or decreasing equity. Okay? I will teach you a mnemonic device that will help you remember, figure it out. Let's see, it's right here, perfect. I wasn't sure if that was the next slide, but it is. I recommend that you get the hang of this acronym DEAL, okay? There's a second acronym over here, GIRLS, but you don't really need the GIRLS acronym if you have the DEAL acronym. Okay, that's just one thing to remember, and it will make your life much easier for this entire semester. So here's how DEAL works. You see DEAL is D-E-A-L, right? These four types of accounts are the ones that increase on the debit side. That would include dividends, expenses, assets, and then losses on the sale of assets. Those four types of accounts, when they increase, we record it in the debit column, which is the left column. Any other type of account When it increases, it would get recorded on the credit or the right column. If you want to memorize girls as well, that'll tell you which ones increase on the credit side. But you really don't need that if you can just remember deal. Okay, so if we look back here, we don't actually see dividends on this list, but distribution to owners would be the same concept. And notice, why did they do it like that? Oh, I see. What they're saying here, okay, this is a little confusing the way they laid it out. They're saying that these items here decrease equity and these items increase equity. Okay, but distributions or dividends, expenses, assets, and losses are deals. And those are the ones where you would record them on the left or debit side when they go up. Okay. Now, a couple things I'll point out. E stands for expenses, not equity. Students get that confused sometimes. And L stands for losses, not liabilities. Okay. As long as you remember dividends, expenses, assets, and losses, you know which accounts increase on the debit side, which is the left side. Does that make sense? Maybe it didn't sink in completely, but hopefully you get the general idea. So let's say we have an asset like cash that has decreased because we paid a supplier. Remember, we said that assets, when they go up, we record it in the debit columns. But if an asset goes down, then you would record that in the credit column. Okay? So when you try to figure out whether to debit or credit, you have to first figure out which accounts you're talking about. If those accounts are part of deal, then you know that they increase on the debit side, decrease on the credit side. And if they're not part of deal, then you know it's the opposite. They would increase on the credit side and decrease on the debit side, okay? So that's the basis. You'll get used to it. Does anything need clarification? There is a link here in the PowerPoint that goes into more detail on this. If you think that might be helpful, feel free to check that out. All right, let's move on then. So transactions that that impact equity. Okay, we know that some things impact equity, some things do not. So revenue increases equity. Anytime we make a sale, that makes us more valuable as a company. Every expense decreases equity. We know gains increase, losses decrease equity, right? We know that if an owner invests money, that increases equity. And if they take money out through a withdrawal or a dividend, equity goes down. As we heard earlier, assets and liabilities do not necessarily have an impact on equity, right? You exchange an asset for an asset, a liability for a liability, or an asset for a liability, then equity is not involved. Okay. We know most of these terms. We know all of these terms except comprehensive income. That's a new term. It really doesn't come up very much in this course. It includes things like foreign currencies, derivatives, investments, and pensions. Okay, so at least be aware of what that term is, but you're not going to see it very often. Now, you might remember when I showed you the video with James explaining accounting in 14.5 minutes. One thing he mentioned is that there are different steps in the accounting cycle. And the number of steps depends on who you ask. Our textbook says there are 9 required steps in the accounting cycle and then a 10th optional step. As we go through these steps, 3 of the steps are similar. At 3 points in the process of making our financial statements and closing out our books, at 3 different steps, we have something called a trial balance. You might remember James talked about this a little bit as well. A trial balance is simply looking at all of the different accounts that the company has, looking at the balance of every account, and then putting it all on one sheet of paper. And that's what we see here. So this is Cheesy Chuck's Classic Corn Company. This is a trial balance for the month of June. Now, this is not a document you would publish. It's not for people outside the organization. It's just a tool that accountants use in the process of making the financial statements. So, yes, okay. So the trial balance starts with all of our revenue accounts. In this case, the company has only 1 revenue account, and it has $85,000 of revenue from that month of June. Then the expense accounts. You see the company has quite a few different expenses. Each account's balance is listed there. So we know how much expense the company had in June in each of those areas. And by the way, those are the accounts we would use for making the income statement, right? Revenue, expenses, and then if there were any gains or losses, those would go on there too. And so it's pretty easy when you already have a trial balance to then make your income statement. Next, we have assets. Cash and equipment are both assets. So we see at the end of June how much cash we have and how much equipment. Then we have our liabilities. Anytime you see the word payable, that tells you it's a debt. Okay? Not all liabilities have the word payable, but anytime you see payable, it definitely is a liability. So we see we owe money to our suppliers, our accounts payable, and our wages payable is money we owe to our hourly workers as of the end of June. We see how much money the investor has owned at this point in time and how much money they took out. These assets, liabilities, and some of the equity accounts go on the balance sheet. Let me think. Yeah. So we have basically the income statement accounts on top, the balance sheet accounts on the bottom. Now, when you see a trial balance like this one, normally you have 2 columns, a debit column and a credit column. And the reason you would normally separate it that way is because every account has either a debit balance or it has a credit balance. And when you add them all up, you have your total debits and you have your total credits, they should equal. So the trial balance is a way to check your work and make sure you don't have a mistake. If they don't equal, if your debits do not equal your credits, there's a problem. So just like on the balance sheet, your assets have to equal your liabilities and equity. On the trial balance, your debits have to equal your credits. Okay? Are there any questions? Okay. All right, so this is just an example. Then it's the same Cheesy Chuck's company. We see their income statement with their revenues and their expenses. Subtract the expenses from the revenues and you get your net income or loss, right? Okay, that net income goes here on the statement of owner's equity. So we take the beginning capital the beginning amount that the owner had contributed to the company, which was zero. But then they contributed $12,500 during this period. And the profit that we made from the income statement also increases the equity, right? So the owner's contribution and the net income both increase the equity. However, the owner then took out some money from the company, which reduces the equity. So we take the beginning plus what was added minus what was taken out, and we get the ending capital, the ending owner's equity, right, for this company. Does that make sense? Okay, so then that owner's equity of $16,850 from right here gets transferred over to the balance sheet under the owner's equity section. If we add the company's liabilities to the owner's equity, we get total liabilities plus equity. And notice that that equals the total assets of the company. So our balance sheet balances, okay? And okay, this is now a new concept. It's pretty simple, but before we get to this, I just want to check in. How are we doing? Any questions? Anything need clarification? Right. Okay, I mentioned the term liquidity. Remember, that means when you're able to spend money. A house, a building is not liquid because you have to sell it first before you can spend that money. The cash in the bank or inventory that you're expecting your customers to buy pretty soon, that is considered liquid. Current assets are liquid because you can turn them into cash within a year. So here we're going to learn two ratios to measure liquidity. These would be important to investors and to others trying to understand the financial position of the company. A ratio simplifies things. These financial statements we've looked at have been fairly simple, but sometimes they can get more detailed and they can be overwhelming at times to look at, especially multiple financial statements, and then try to decipher and figure out if this company is a good investment. So investors and others like ratios because they simplify all that complicated information down to something pretty simple. Right? So we'll learn two ratios now that relate to liquidity. We'll learn working capital, and we will learn the current ratio. They're both very easy to calculate. Working capital, what it means is how much money does the company have available to work with in the short term. And the way you calculate it, you take the current assets of the company and subtract the current liabilities. And that's it. That tells you working capital. And that's a phrase you might hear out in the business world, especially if you're dealing with business owners or people in finance. They say working capital is how much money the company really has to work with in the short term. How do we calculate working capital again?
Assets minus liabilities.
Current assets minus current liabilities. Okay. Now another ratio is the current ratio. And the way we calculate that is with the same two things, we just divide. We take current assets and divide by current liabilities. So in this case, instead of a dollar amount, what it gives us is a ratio or relationship to show us how much bigger our current assets are compared to our current liabilities. Oh, we're already at the summary slide. So as we go through our exercises and problems, we'll get to practice and actually calculate some working capital and current ratios. But for now, let's summarize what we have learned in this chapter. We've learned about the different financial statements. and the purpose that they serve to help people understand what's going on with the company. We know that they include the income statement, statement of owner's equity, balance sheet, and statement of cash flows, right? So we're already familiar with 4 different financial statements. The income statement tells us how profitable the company was or wasn't, right? It includes revenues, expenses, gains, and losses, which result in either a net income, meaning we were profitable, or a net loss, meaning we lost money. We are familiar with the statement of owner's equity, which shows how much the owners have contributed to the company and how much they've taken out. What do we call that statement if it's a corporation?
Stockholder.
Yes, statement of stockholders' equity. So same idea, just different name. We're familiar with the balance sheet. That tells us the assets, liabilities, and equity of the company, and they're supposed to balance, right? And we're familiar with the statement of cash flows, which shows how much cash came in and went out for a period of time. And because of the accrual basis of accounting, we need that to understand our cash flow because our income statement doesn't tell us our cash flow. The last chapter of our semester will be chapter 16, which is on statement of cash flow. So even though we have a basic understanding of the statement of cash flow, the detail of how you create a statement of cash flow, we're not actually going to get into until the very end of the semester. And I think it's the hardest chapter. So just be prepared. I know it's unfortunate that it falls in the last week of class. You'll get through it. What we usually do is we get a head start on that chapter during week 15 so that it's not quite so intense. But it's a tough chapter. A few other things we learned. We know that sole proprietorship, partnerships, and corporations are the most common forms of business. And there are some slight differences in how you do the accounting between them. Chapter 15 is going to be one of the easiest chapters in my view, and that will be on partnership accounting. We know the accounting equation, which can be expressed in a couple different ways. We know that many things influence the equity, but changes in assets and changes in liabilities don't necessarily change the equity, right? We looked at some of these different types of accounts: revenues, expenses, gains and losses, assets, liabilities, and equity, investments by owners, distributions to owners, and the rare comprehensive income type of account. Know that when we make the financial statements, we need to make the income statement before we can make the statement of owner's equity, which we need before we can make the balance sheet, right? Depending on which method you're using for the statement of cash flows, you might also need the income statement before you can make your statement of cash flow. And then lastly, we learned about some ratios, working capital, which tells you how much cash you have, or how much money you have available to work with in the short term, and the current ratio, which is a comparison between your current assets and current liabilities. So we have gotten through chapter 2, all right? I'll stop recording, and what we'll do is we'll move back into the exercise set and work our way through it.